All right, let's talk about the one piece of investment advice that absolutely everyone has heard. You know the one, don't put all your eggs in one basket. It's treated like the golden rule, something you hear from your grandpa all the way to the top financial gurus. But what if I told you that this seemingly simple, safe advice is actually a trap? Well, that's exactly what we're going to dive into today.
I mean, think about it. The standard approach to investing feels a lot like a formula, right? You tell someone your age, your income, how much risk you can stomach, and poof, out comes this perfectly diversified portfolio. It's like the instant noodle approach to growing your wealth, and it's sold to us as the safest, most responsible thing you can do. But is it really?
This phrase is the absolute bedrock of modern investing. It's so deeply baked into how we think about money that to even question it feels kind of wrong, doesn't it? We just accept it as fundamental truth. But what if that so-called common sense is actually preventing us from being truly secure?
And see, this is the question that almost nobody stops to ask. We get so obsessed with protecting our individual eggs, our different stocks or bonds, that we totally forget to check on the basket that's holding everything. And that, well, as we're about to find out, that can be a massive, massive mistake.
Okay, so to really understand why so many of us fall for this trap, we have to look at the psychology behind it. Because this is about more than just numbers and charts, it's about a very powerful, very human need to feel safe and secure.
For most people, the word diversified has pretty much just become a synonym for safe. It's this comforting security blanket that lets us sleep at night, believing our money is protected. The problem is, that same blanket can end up blinding us to the real risks, the much, much bigger ones that are out there.
But then you get a quote from someone like Warren Buffett, one of the greatest investors ever, and he flips the whole idea on its head. He sees diversification not as a smart strategy, but as a defense against not knowing what you're doing. It's basically hoping you get lucky by owning a tiny piece of everything.
And that's where the real danger lies, in this false sense of security. It's almost like a financial painkiller that lulls you into thinking everything's fine. We feel like we've checked the be responsible box, and that leaves us completely exposed to the huge threats we were trying to avoid in the first place.
So what are these giant risks that diversification just can't handle? Well, to get that, you have to understand that in investing, not all risk is created equal. There are two totally different kinds, and diversification, it really only helps you with one of them. So here's the breakdown. On one side, you have what's called non-systemic risk. Think of this as the one bad egg problem. It's the risk that a single company you invested in has a disaster. But on the other side, you have the much scarier systemic risk. This is the basket breaking problem, the risk that the entire system fails. And that's a whole different ballgame.
Let's make this real. The BP oil spill? A total catastrophe for BP stock. A perfect example of non-systemic risk. But the rest of the market kind of shrugged it off. Now compare that to the 2008 financial crisis. That was a systemic tidal wave. It didn't matter if you owned great stocks or bad stocks. Pretty much everything went down because the entire basket was breaking.
And here's the kicker, the great irony of it all. By spreading your money all across the market to protect yourself from one company failing, you are actually guaranteeing that you are exposed to the entire market failing. When the whole system catches a cold, your diversified portfolio gets full-blown pneumonia.
Okay, to really make this stick, let's use a super simple analogy. It makes everything we've been talking about crystal clear. Just think of it like a flu shot. It's a really useful medical invention for sure, but it's designed to do a very specific job. It's not some magic pill that makes you invincible, and it definitely doesn't protect you from everything. So, a flu shot is fantastic at protecting you from, well, the flu. And in the same way, diversification is really effective at protecting you from the financial flu of one single company in your portfolio going belly up. For that one job, it works great. But that is where its power ends. Right? A flu shot isn't going to do a thing to protect you from a broken leg or a heart attack. So what are the big financial diseases that your diversification flu shot offers zero protection against? First, you've got systemic risk, the big one we've been talking about, where the entire market crashes. Then you have purchasing power risk. You probably know it as inflation, the silent killer that just eats away at the value of your savings day after day. And don't forget sovereign risk. That's when a whole country's government makes bad choices and tanks the economy. Diversification doesn't help with any of these. So if diversification isn't the whole answer, then what do you do? Well, this is where we move from amateur hour to the professional leagues. Sophisticated investors use a strategy called hedging. It's not about hoping for the best, it's about actively playing defense.
The easiest way to think about hedging is to think of it as insurance for your portfolio. You're literally paying a small, calculated cost, a premium, to protect yourself from a huge, catastrophic loss. The goal of a hedge is not to make you more money. The goal is to make sure you don't lose a ton of money.
Let's look at a simple example of how this works. You've got an asset like DIA, which tracks the Dow Jones. When the stock market goes up, DIA goes up. Easy enough. But now look at its hedging partner, an inverse ETF with the ticker symbol DOG. When the market is doing great, DOG actually goes down in value. But, and here's the magic, when the market crashes and DIA is plummeting, DOG takes off like a rocket. It's a financial cushion that pays you when things are going wrong.
And inverse ETFs are just one tool in the pro's toolbox. They use all sorts of things, like volatility products that are designed to spike when fear spikes in the market. They use option strategies like protective puts, which are like a specific insurance policy on a single stock. And of course, they often hold assets that aren't correlated to the stock market, like precious metals. It's a much more active, much more strategic way to manage risk. Look, the point here isn't to tell you to just throw diversification in the trash. It can be a decent starting point, but that's all it is, a start. It is not the finish line. Your real protection, the thing that will actually build and preserve your wealth, isn't a simple rule. It's education. This, right here, this is the real path to financial security. It's about building genuine skill in 4 key areas. First, fundamental analysis, truly knowing what you own and why it's valuable. Second, technical analysis, being able to read the overall health of the market. Third, learning how to generate cash flow, whether the market is going up, down, or sideways. And finally, number 4, what we've been talking about, real risk management, where you actively protect what you've built.
So let's bring it all back to that original analogy. For a smart investor, the goal isn't just about scattering your eggs into a bunch of different baskets and crossing your fingers. The goal is to understand the basket itself, the market, the economy, and then get the skills you need to reinforce that basket to make it strong enough to handle any storm.
So let me leave you with this final thought. Don't settle for just playing to not lose. That's a strategy built on fear. The real goal is to play to win. And you do that by arming yourself with knowledge, by moving past the simple rules everyone else follows, and by taking active, educated control of your own financial destiny.